Hey guys, Assalamualaikum. Welcome back to another virtual lecture. In this video, we will learn about monetary policy. You may have remembered at the beginning of our course, I did mention that we will be learning demand-side policies only. And there are two types of policies under the demand side, which are fiscal policy and monetary policy. The main reason why they are called demand-side policies is because these policies will affect or influence the aggregate demand. Now let's take a look at the definition of a monetary policy. As mentioned, monetary policy is a branch of demand-side policy. It basically attempts to achieve full employment, price stability, and economic growth through control of the monetary system via controlling money supply, controlling interest rates, or rationing credits. Most economists agree that the quantity of money supplied affects the overall price level, interest rate, and exchange rates, unemployment rate, as well as the level of output. You may have remembered that we've learned about the fractional reserve system, as well as the demand for and supply of money. Now, these three concepts are very important for us to understand how the tools of monetary policy work. Okay, so by understanding how these tools work, we will know how they affect the money supply and the interest rate. Now, why is it important for us to know all of this? Because when it comes to changes in interest rate, you know that interest rate is a factor of several of the elements of aggregate spending, right? So this is basically, so aggregate spending or aggregate expenditure here is equivalent to aggregate demand. So as you can see here, this is why the monetary policy is a demand-side policy, because in the end, it will affect changes in aggregate demand. So now let's take a look at what are the tools of monetary policy. There are generally three tools of monetary policy. One is called the open market operations. And then the second tool is called the reserve ratio. And finally, the third tool of monetary policy is the discount rate. Overall, the effects of all of these tools will influence money supply and interest rate. Let's look at these tools one by one. The first tool of monetary policy is open market operations, or OMO for short. Now, as you can see, there's a market word here. So whenever there's market, what it means is it involves buying and selling, right? So what is it that this particular market buys and sells? Okay, so basically OMO involves the activities of buying and selling government bonds or securities, okay? Government bonds or securities. So who will be doing these transactions? The central bank. All right, so where will the central bank be doing these transactions? The open market, from either commercial banks or the general public. That is why this tool is called the open market operations. Now let's take a look at the first activity, okay? Buying of securities. So who will the central bank buy securities from? The central bank can either buy securities from commercial banks or the general public. When the central bank buys bonds from the commercial bank, buys bonds, what happens is the central bank will give up their rights or their holdings of the securities or government bonds to the commercial banks. Besides giving up their rights and holdings of these bonds or securities to the commercial banks, central bank will also make payment to the commercial banks. Now, these payments, they will increase the amount of reserves available in the commercial banks. Now, to understand this, I'm showing you an excerpt of my last video under the title Creation of Money. Okay, so as you can see here, this is a commercial bank, Bank A, and this is its account. And as you can see, here's the amount of reserves, required reserves that goes to the central bank, and excess reserves, which are the difference between the actual reserves and the required reserve, okay? So what happens is now is when central bank buys bonds or securities from the commercial banks, the central bank will pay, right, will make payment to the commercial banks. So here, in the account of the commercial bank, it will be debited. Okay, that payment will be debited here. And the amount of reserves increase will be the same amount of the purchase of that government bonds or securities. Okay, so as we've seen before, all banks must be loaned up. So if there's any extra or additional reserve, okay, that amount will be able to be lent out to the public, right? So the amount of loans will be more. So this is what it means by whenever the central bank buys bonds from commercial bank, right? The amount bought will be increased here in the form of more reserves of the commercial banks. So this increased reserve will increase the lending ability of the commercial banks. Therefore, using the money multiplier concept that we've learned before, money supply will also increase. How about if the central bank buys bonds from the public? Okay, I'll show you the account to see the effects. Okay, let's look at the account. So what happens when the central bank buys bonds from the public instead of the commercial banks directly? Now, when central bank buys bonds from, let's say, Ali, okay, so Ali will sell his securities or bonds to the central bank. And in return, the central bank will make payment to Ali in the form of a check. Now, Ali, once Ali received that check, he will deposit that check to his commercial bank. Let's say the commercial bank is Bank A. Okay, so what happens is Bank A will get more deposit. Okay, here's Ali, right? So Ali will deposit his check. So the amount he will increase. Now, the more this amount increase, the more will be the increase in reserves as well. Okay, but only by a fraction, okay, because a part or fraction of it will go to required reserve. But still, we will still have excess reserve, all right? So the more excess reserve there is, the more ability to lend this particular commercial bank has, right? So it will be the same effect, okay? Okay, let me show you an example. Say the central bank buys bonds. Okay, when I say bonds, it also includes government securities, okay, from the commercial banks. Okay, right, so let's say the worth of this bond is $1,000. Okay, so what happens is, should I make it bigger? Okay, there it is. So what happens is, it will create new reserves, okay, of the banks, okay, of the commercial banks. Okay, when I write banks, it's commercial banks. It will create new reserves of the banks by the entire amount of this purchase. Okay, now, so what that happens is, it will create a demand deposit, right? Because now the bank has additional ability to lend. Okay, so this will increase the money supply. Okay, so let's give an example. Let's give some figures. Okay, say, or let's assume reserve ratio is 20%. Okay, so let's calculate. First things first, to know how much money is being created here, we need to calculate first the money multiplier, right? So M is 1 over R, okay, which is 1 over 20%, which is 5. Okay, so now how much is the total amount of money being created here? So the demand deposit, the formula is the first excess reserve times the money multiplier, right? So the first excess reserve in this case would be 1,000. Okay, why 1,000? Because the central bank buys directly from the commercial banks. So there's no in between. Okay, so basically the money is being put into the commercial banks directly. Okay, so excess reserve would be 1,000 just now, the new excess reserve. Okay, so times the multiplier, 5. So the total amount of money being created is $5,000. So this is basically due to the multiple expansion of bank credit, or the way, yeah, okay. Now let's see the other case where the central bank buys bonds, but this time from the public. Let's assume the amount of bonds is the same. The worth is the same at $1,000. So what happens here is, okay, so it will create an initial deposit, okay, initial demand deposit. okay, by the entire amount of the purchase, okay? However, because this time the central bank buys it from a person or the public, this person or the public will deposit his check to a particular commercial bank. Okay, so when that happens, that commercial bank will have to take a portion of that amount and put it in the required reserve, right? Okay, so in other words, okay, this 1,000, we need to deduct the amount of required reserve, which is 20% of 1,000. Okay, so this one goes to required reserve, which is 200. So 1,000 minus 200, commercial bank only has 800 now to lend out. Okay, so the banking system will be able to only lend out 800 as compared to the other example just now where the whole bank, the bank can lend out the entire 1,000. Okay, so anyway, once we're here, we can continue the calculation. You can see money multiplier is still 5, 1 over 20%, so it's still 5. But this time the difference is here. When we want to calculate the amount of demand deposit created, okay, the first excess reserve multiplied with the multiplier. Now the excess reserve this time is 800 only, okay? So it's 800 times 5, which will get 4,000. However, the total money created by the banking system is actually this 4,000 that's created through the multiple expansion of credit, plus, don't forget the initial 1,000, okay, $1,000, the initial demand deposit that this person received from the central bank, okay? So the overall amount would be 5,000, which is similar to the case where as if the central bank buys bonds directly from the commercial banks. Okay, so we've done with the case of buying securities. Now let's take a look at what happens when the central bank wants to sell securities, okay? Selling securities. So just like before, okay, the central bank can sell securities to these two parties, to the commercial banks and to the public. Okay, as you can see now, I'm trying to make the arrow go opposite direction. So by selling securities, what it means is the central bank will be the one selling, right? Sell the bonds or securities, okay? And what happened is now the commercial bank would be the one to make payment, right? To the central bank. So can you just try to reverse everything that we've seen just now? Okay, so what happened is when the commercial banks pay the central bank for the amount of bonds that they bought, okay, so effectively this payment will be made against the commercial bank's reserves. Thus, the reserves will fall. So whenever the amount of reserves fall, money supply will also fall. Okay. Likewise, when the central bank sells bonds to the public, okay, this public will have to make payment, right, to the central bank. So what that means is this person or the public will need to draw out, or will need to draw out a check against his account in a particular commercial bank, say Bank A again. So when that happens, the central bank will draw this check against the commercial bank and will reduce Bank A's reserves. Okay, and the same thing will happen, the money supply will fall. Okay guys, so here I'm sharing with you an excerpt of my lecture notes. In case whatever I explained just now wasn't that clear, here you can pause this video and read the notes. Okay, this is the case of the OMO. Okay, as I mentioned to you before, OMO consists of two activities, the buying of securities and the selling of securities. Now, under each activity, the central bank can do it with two parties. Here is when the central bank wants to buy securities from the commercial banks, and here is when the central bank wants to buy the securities from the public. Likewise, here is when the central bank wants to sell securities to the commercial bank and to the public. Okay, so the explanation here is basically what I mentioned to you before. But again, if you want to, read, okay, because I know some of you do not have your lecture notes with you, so I'm sharing with you. Okay, here I'm going to share the selling. Okay, so the explanation is very brief because it's just note form, but I hope it will give you, a bit of understanding as to how the OMO works. Now, in case you're wondering, what makes the banks or the public willing to sell or buy securities from the government? Because, the central bank can just offer to buy or to sell, but they cannot force the public or the bank to do so, right? But this is what happens, okay? Now, it depends. Remember, we've learned that there's a negative relationship between the prices of bonds and interest rates. Okay, so this is the explanation. If, let's say, the central bank wants to buy government bonds, okay, what that means is the demand for bonds will increase, right? So we know that when the demand for bonds is relatively more than the supply of bonds, it will push the price of bonds up. Okay, and we know that there's a negative relationship between the price of bonds and interest rates. So when the price of bonds increases, interest rate will fall. Now, a fall in interest rate would indicate that it's cheaper to hold money, right? Because interest rates is the price of money. So when it's cheaper to hold money, people want to hold more money instead of bonds. So that is why they are prompted or encouraged to sell their bonds. Alternatively, if the central bank wants to sell their bonds, what happens is there'll be a lot of supply of bonds in the bond market. Okay, so when there's relatively more supply than demand for bonds, what happens is the price of bonds will fall. Now, as we know, there's a negative relationship between the price of bonds and interest rate. So when there's a fall in the price of bonds, interest rate will increase. A higher interest rate indicates that it is more expensive to hold money. So people will hold less money. So when people hold less money, they will hold more bonds. That is why they are prompted or encouraged to buy bonds. Now let's look at the second and third tool of monetary policy, reserve ratio and discount rate. For reserve ratio, I'm just going to show you the lecture notes because I think it's relatively straightforward. Here you can see that the central bank also manipulates the reserve ratio in order to influence the ability of the commercial banks to lend. Okay, because when the reserve ratio changes, the money multiplier will also change, right? Remember the formula? Okay, M equals to 1 over R. So can you imagine here, if the amount of R increases, the money multiplier will fall. Whereas if the R here falls, the money multiplier here will increase because there's a negative relationship between money multiplier and reserve ratio. Okay, so now let's look at the explanation. Say the central bank wants to reduce money supply for whatever reason. Okay, so what the central bank would need to do is to raise or to increase the amount of reserve ratio. Because when the reserve ratio is increased, the amount of required reserve that commercial banks have to keep with the central bank also increases. Okay, and therefore will reduce the amount of excess reserves. Okay, so remember, excess reserves is basically related to the bank's lending ability, right? So the lower the bank's excess reserves, the bank's ability to extend loan will also fall. So you know that when banks aren't able to extend loan, okay, it means they are not able to create money, and therefore money supply will fall. Alternatively, if the central bank wants to increase money supply for whatever reason, what they need to do is to reduce reserve ratio. Okay, so because when this amount is reduced, the amount of required reserves that commercial banks keep with the central bank will also reduce. Okay, so what it means is the commercial banks now will have more excess reserves and therefore increase their ability to lend. The more the commercial banks are able to lend, the more money is being created through the fractional reserve system. Okay, so I hope you can see the relationship here. Here I'm going to show you the summary for your convenience. The higher the reserve ratio, it will lead to a reduction in money supply. If there's a fall in reserve ratio, it will lead to an increase in money supply. And finally, let's look at the third tool of monetary policy, which is discount rate. Now, before we go into the details, you need to know what discount rate is first. One of the functions of the central bank is to be the lender of last resort to the commercial bank. Because sometimes maybe the commercial banks may experience or face some sort of problems where they need money. Okay, so it's not just us people who need money. Sometimes the commercial banks need money as well. So where can the commercial banks get money? They can borrow from the central bank. So that's what it means by the central bank being the lender of last resort. And just like the public, whenever we borrow money from the commercial banks, we have to pay interest, right? Quote unquote. So commercial banks will also need to pay interest whenever they borrow from the central bank. So this interest is called the discount rate. So how does it work? How does this discount rate work? Okay, so you can see it better. The central bank will give short-term loans to the commercial banks, right? So what that means is whenever a loan is given to the commercial bank, it will increase the reserves belonging to that commercial bank. And you know that whenever reserves increase, the new excess reserve will be made. Okay, so whenever there are more excess reserves, it will increase the commercial bank's ability to lend. Whenever the commercial banks can lend more, they can create more money. So what is the implication of all this? This is the effect. If the central bank, for whatever reason, wants to restrict the supply of money or make it fall, central bank just needs to increase the discount rate. Okay, because then it will be more expensive, right, for the commercial banks to pay back. So it serves as a form of discouragement for the commercial banks to borrow. Okay, so if discount rate is increased, banks will borrow less from the central bank and therefore money supply falls. If the central bank wants to increase money supply, the opposite, all they have to do is just to reduce the discount rate. So since it's cheaper to borrow, banks will borrow more from the central bank and money supply will increase.